Welcome to the Fed Unpacked, a concise tour of how the Federal Reserve operates and why it matters, based on a talk by Dr. Microlearning Z from January 2026. Over the next slides, we'll unpack the Fed's mission, tools, and institutions, using diagrams to clarify complex interactions so you can follow how policy choices ripple through markets, banks, and everyday payments. At the heart of the Fed's mission is the dual mandate: maximum employment and stable prices, which means balancing growth against inflation. The slide's diagram shows how policy tools like open market operations, the discount rate, and reserve requirements feed into metrics such as PCE inflation and the U3 unemployment rate, and why sometimes rates rise even as job gains continue. This slide maps how the FOMC sets the federal funds target through a three-stage process. Pre-meeting inputs like staff forecasts, beige book anecdotes, and market signals feed into the meeting, which then produces post-meeting outputs such as the consensus statement, dot plot projections, and the chair's press conference, with forward guidance ultimately steering global short-term rates. Here we look at the Fed's monetary policy levers and how they transmit to the real economy, illustrated by a central transmission wheel: open market purchases, discount window lending, interest on reserves, and reverse repos alter money market rates, bond yields, and mortgage coupons, which in turn shape consumer credit conditions and broader economic outcomes like spending and investment. The Fed's regulatory framework blends rulemaking, supervision, and enforcement to protect system stability and consumers. The slide shows a flow from writing rules and approving mergers, to examining banks with stress tests and living wills, and finally to enforcement actions tied to supervisory ratings, which produce corrective measures intended to reduce systemic risk and ensure orderly markets. Financial stability relies on continuous monitoring and crisis tools, depicted as a cycle of risks like asset bubbles, funding freezes, and cross-border spillovers. When problems arise, bodies such as the FSOC, the Discount Window and Emergency, Section 133, powers are activated, and post-2008 reforms like SIFI designations, swap lines, and stress buffers help contain contagion and bolster resilience. The Fed's role in the payment system covers settling trillions, reducing risk, and anchoring resilience across three pillars shown here: high-value and real-time systems such as FedWire and FedNow that settle in central bank money, core operations that supply currency and run treasury auctions, and policy functions that ensure pricing, access, and overall system resilience for daily transactions. This slide illustrates the plumbing between the Fed and Treasury. The Treasury General Account receives tax receipts and funds inflows while auctions issue new debt and redemptions return principal, and federal outflows move through Fed-operated payment rails. Those TGA swings influence bank reserves and short-term rates, so Treasury operations and Fed reserves are tightly intertwined in practice. The Fed performs 5 core functions that together keep the financial system working. As a rate setter, it influences borrowing costs and inflation. As a bank supervisor, it enforces rules and guards deposits. As a crisis firefighter, it provides emergency liquidity. As a payment plumber, it runs essential transaction systems. And as a fiscal agent, it manages government accounts and Treasury securities.